You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. Really glad you could join us today. We're going to slice through a whole stack of sources, articles, research, our own notes, everything. The aim is to give you a lightning fast, but, really thorough understanding of the world's most critical developments right now. We'll unpack everything from, say, subtle currency shifts all the way to those high-stakes geopolitical maneuvers. Our mission, basically, to pull out those key nuggets of knowledge, those aha moments, so you can get up to speed quickly and really feel informed.
And that's so important, isn't it? Because what often looks like just a list of headlines is actually, it's a tightly woven tapestry. Everything's connected. We'll show you how, for instance, a court ruling on tariffs over in the U.S. can actually send ripples through foreign exchange markets globally. Or how a conflict in one region might almost instantly shift commodity prices or even strategic alliances thousands of miles away. So our goal isn't just telling you what happened, but digging into the why, the cause and effect underneath it all. That gives you a much richer picture.
Exactly. Those undercurrents, that's what makes it so compelling. Okay, so let's dive right in. Economic currents moving the markets. Let's start with foreign exchange. We're keeping a close eye on the dollar index. Now, for anyone maybe less familiar, this isn't just one measure of the dollar. It's key. It tracks the U.S. currency against 6 major partners: euro, yen, sterling, etc. It's like a quick pulse check on global confidence in the U.S. economy. And recently, it softened just a little bit, partly because U.S. markets were closed for Labor Day, so trade was quieter. But there was something bigger going on underneath. Investors are still digesting that weekend ruling from a U.S. appeals court. The one that found most of President Trump's tariffs were, illegal. Now, hold on. Those tariffs are still in place while things go through more legal steps. But that initial ruling, it definitely sent a bit of a tremor through the markets.
Yeah, it really did. And what's fascinating is how fast that kind of legal uncertainty just weighs on market sentiment. You don't need the final word for traders to start thinking, okay, what if? It just creates this cautious tone. And that feeling was sort of amplified by comments from San Francisco Fed President Mary Daly. She noted that policy, it'll soon need recalibrating, which brings up this critical dilemma for central banks everywhere, really. How do you navigate these conflicting signals? You've got hints, maybe labor momentum is slowing down, which might suggest, okay, maybe ease off the rate hikes. But then you have tariffs, which inherently push prices up because imports get more expensive.
Right. Sounds like a classic damned if you do, damned if you don't kind of spot for policymakers. So what's the insight there? How are they actually trying to approach this tightrope walk? Is there a less obvious angle?
Well, it's definitely a tightrope, yes. But what seems to be emerging from, various central bank discussions isn't just balancing. It feels like a subtle shift, maybe towards prioritizing supply chain resilience and longer-term economic stability, sometimes even over strictly controlling short-term inflation. It's like they're acknowledging these external shocks, like tariffs, aren't so temporary blips anymore. They might be more structural. So policy needs to be more adaptive, maybe even anticipatory, rather than just reacting after the fact, looking beyond just the next quarter.
That's a key point. A structural shift in thinking, not just reacting. Okay, so while the dollar was dealing with all that, other major currencies had their own stories, right? The euro, for instance. It managed to edge back over 1.1700, even though, ECB policymakers were putting out warnings about risks from cheaper energy, and also a stronger euro itself, which isn't great for exports. Sterling also held above 1.3500, but its focus seems very domestic, doesn't it? Fiscal policy, who's advising the government? That always adds political uncertainty. Markets don't love that. The yen, though, was trading pretty indecisively, kind of stuck. Apparently, Japan's top trade negotiator had to postpone his U.S. trip because of these ongoing squabbles over agricultural purchases. Just shows how even a canceled meeting can reflect those deeper tensions and freeze up a currency.
Mm-hmm. And then if you look south, the Antipodeans, that's the Aussie and Kiwi dollars, they were surprisingly resilient, held firm even though we saw mixed PMI readings out of China. The PMI, the Purchasing Managers Index, that's that key forward-looking indicator, right? Gives an early read on manufacturing health. So mixed signals there, But the currencies were supported, importantly, by a stronger daily yuan fix from the People's Bank of China.
Okay, wait. A stronger yuan fix. China's central bank makes its currency more expensive, and that helps the Australian and New Zealand dollars. How does that work? Seems backwards.
It's a great question. It really highlights how interconnected things are. See, when the PBoC sets the yuan stronger deliberately, it makes Chinese exports pricier, yes, but it also makes imports cheaper for Chinese buyers. So for countries like Australia and New Zealand who sell huge amounts of commodities to China, well, their goods suddenly become a bit more attractive, more affordable for Chinese purchasers. It's a direct, if sometimes subtle, boost to their export economies. Supports their currencies even if other data looks a bit soft. It's a powerful lever China has.
Okay. That makes sense. Economic leverage in action. Got it. Now let's shift from currencies over to commodities. This is where things get really interesting. Oil prices. They eased back a touch. Brent crude, that's the international benchmark, just above $68.8 a barrel. WTI, the U.S. one, was hovering near $64. That slight difference often tells you something about U.S. inventories or pipelines, regional stuff. But the easing seemed mostly down to just a generally subdued risk appetite across markets. And honestly, not much fresh energy news to drive things. A bit of a holding pattern.
Yeah, a bit quiet on the oil front. But if we connect this to the bigger picture, especially thinking about Europe, there's been a really significant positive development. Europe's natural gas storage sites. They've now passed the 70% full mark. Why that's so crucial is it's way ahead of their November target. This isn't just a statistic. It's easing some really serious worries about winter shortages. It means less immediate price pressure, more energy security. Frankly, probably a huge sigh of relief for everyone bracing for colder weather. It strengthens their position quite a bit.
That is a big deal, a huge relief for many. Okay, and in times like these with complex signals, investors often look for safe havens, right? Precious metals. Gold started quiet, like we said, thin holiday trading, but then it found support as silver. Silver surged, climbed above $40 an ounce, highest since 2011. That's a major move for silver, sometimes called gold on steroids when markets get volatile. Copper, though, totally different story. More tentative, kind of lacking direction amid all this trade uncertainty and those uneven Chinese data points we mentioned.
And that divergence is exactly the key insight, I think. Silver surging reflects that deep demand for safety, sure, but maybe also some speculative interest, betting on inflation or maybe a weaker dollar, plus its industrial uses. But copper, Dr. Copper, right, because it supposedly predicts economic health, its hesitation really highlights the economic anxiety. It's a direct mirror of the uncertainty about global manufacturing demand. Heavily influenced by China's choppy recovery and those trade frictions, investors just aren't confident enough yet about industrial demand to push it higher.
Okay, so from that intricate dance of currency and commodities, let's pivot. Focus right on the trade tensions and this ongoing tech tug of war. It's playing out globally. We mentioned it with the dollar, but that U.S. appeals court ruling, casting doubt on the legality of Trump-era tariffs, it really needs repeating. It's central to so much uncertainty. And while those tariffs are still active during appeals, the White House says it'll keep defending them. The Attorney General announced more appeals. So this isn't just a quick legal fight. It's a drawn-out battle with big economic consequences for businesses, for you, for consumers.
Exactly. And it highlights something crucial. Beyond fighting over past tariffs, we're seeing very concrete, forward-looking actions that are fundamentally reshaping the tech sector. The U.S. administration explicitly revoked authorizations for huge players like Intel, Samsung, SK Hynix, stopping them receiving U.S. chip-making equipment in China without special licenses. This isn't just about finished goods. It's about controlling the actual tools used to make the technology. It significantly tightens restrictions on critical tech supply chains.
Wow, that is a massive move. What does that even mean for innovation, for manufacturing globally, when you restrict access to the machinery that builds the future?
Well, this is where that idea of decoupling really starts to bite, I think. What seems to be emerging is this almost a dual ecosystem approach. Companies are essentially being forced to create separate, probably less efficient, innovation pipelines. Different manufacturing capabilities for different geopolitical zones. Now, that inevitably slows down overall global tech progress, right? Because you're duplicating effort, limiting the cross-pollination of ideas.
Right.
But at the same time, it creates distinct regional advantages for those areas that can develop their own, maybe more isolated tech capabilities. It's a huge strategic move, trying to shape the tech landscape for decades, moving away from a globally integrated system towards something more fractured.
That really does sound like a tectonic shift for the tech world. Meanwhile, on the diplomatic side, China's Commerce Ministry confirmed their senior negotiator, Li Chenggang, met U.S. officials in D.C. last week. And the ministry stressed, the need to manage differences, expand cooperation through dialogue. So even with these really sharp tech policy moves, the lines of communication are still open, which is always fascinating, isn't it? That complex dynamic, like saying, we'll talk, but we'll also act.
Precisely. And while those high-level talks happen, we see the real-world impact in things like agricultural trade frictions. It's ongoing. Beijing, for example, has noticeably ramped up soybean purchases from Argentina and Uruguay, while at the same time holding off on new U.S. imports. That's not just changing suppliers, it's a clear signal. An economic lever being pulled. It shows how these disputes hit home, affecting farmers' supply chains far from the negotiating rooms, creating new dependencies, disrupting old ones. It's strategic economic statecraft in action.
Absolutely. Okay, from that complex economic chess game, let's turn to the geopolitical hot zones. Acute tensions flaring up around the world, starting in the Middle East, a region under, immense strain. Israeli Prime Minister Netanyahu announced strikes targeting Hamas's chief spokesman specifically. Palestinian media reported heavy raids in Gaza. The situation just remains incredibly volatile. Tit for tat.
And what's really critical to grasp here is how multi-layered it is. It extends way beyond just the immediate Israeli-Palestinian situation. We're seeing a dangerous escalation. For example, Yemeni Houthi rebels confirmed their senior officials were killed in Israeli strikes, and they immediately threatened retaliation. These aren't separate incidents, they're connected. Then you had reports of Houthis raiding UN offices in Sana'a, detaining staff, which is deeply worrying. It cripples humanitarian work in a desperate place. Plus, maritime monitors flagged a possible projectile incident off Saudi Arabia's coast. All these things together, they paint a picture of a region where multiple actors, state and non-state, are involved, creating this incredibly complex web of threats and responses that could easily spiral further.
And where does Iran fit into this picture? What's their stated position?
Well, amidst all this, Iran's President Pezeshkian repeated that Tehran doesn't seek war. But, importantly, he accused the U.S. and Israel of trying to divide Iran. Now, that statement is key because it frames Iran's actions, and by extension, the actions of groups like the Houthis, as defensive or responsive, not purely aggressive. It's an attempt to shape the narrative, right? Position Iran as reacting to perceived external threats. It just underscores those deep geopolitical fault lines and the huge risk of miscalculation.
A very dangerous, interconnected situation. Okay, let's move to the Russia-Ukraine conflict, also escalating. President Zelensky pledged new strikes inside Russia itself. This came after Ukrainian forces claimed they hit Russian oil refineries. That signals maybe a broadening of Ukraine's strategy, hitting key infrastructure deep inside Russia.
And if you connect that to the wider war, Russia has kept up its heavy drone and missile attacks. Its military reports steady progress in the east and south of Ukraine. Moscow's defense chief talked about establishing buffer zones along the border. The Kremlin claimed near total control of Luhansk, significant parts of Kherson, which raises that really important question. How do these strategic claims and counterclaims, which often conflict, how do they influence the international response and the prospects for any kind of resolution?
That is a vital point. In a war driven so much by information, how do allies, or adversaries for that matter, make decisions when the battlefield picture is so polarized?
It makes it incredibly challenging for decision makers, doesn't it? These reports aren't just tactical updates, they're political statements too, designed to shape perception at home and abroad. For allies, conflicting claims can really complicate the decisions about aid, about intervention, could lead to Ukraine fatigue maybe, or different ideas about strategy. For adversaries, well, it allows them to exploit any doubt, influence how much leverage each side is perceived to have. Ultimately, it means the information war is just as critical as the ground war. It shapes international resolve, it shapes the potential paths towards ending the conflict, or even just de-escalating.
And the European response seems strong, but also cautious. European Commission President von der Leyen signaled a clear roadmap, sending troops, long-term financing for Ukraine's forces, coordinated with the White House. That sounds like a strong commitment. But then German Chancellor Merz struck a more cautious note. Hopes for a ceasefire, sure, but warned the war might drag on. And alongside that, EU officials are prepping new sanctions, so sustained economic pressure on Moscow continues.
Right. And the U.S. perspective lines up with that continued support, but with a real strategic focus. Washington approved more arms sales, crucial support like Starlink services, absolutely vital for communication, command and control, and also sustainment for Patriot air defense systems, essential against those drone and missile attacks. This isn't just sending more stuff, it underscores a long-term strategic commitment. Providing immediate help, yes, but also building Ukraine's defense capability for the long haul. It's a clear message of backing, countering Russia's narrative of attrition.
Okay, so pulling back. What does all this mean for the broader global stage, especially these shifting alliances, these power dynamics we're seeing? It's fascinating. Chinese President Xi Jinping, using the Shanghai Cooperation Organization Summit, called for deeper security ties, closer cooperation with India, Turkey, Armenia. That seems like a very clear signal, doesn't it? Beijing pushing to strengthen its regional influence, not just economically, but militarily, building alternative blocs, maybe challenging Western-led structures.
And then you see a contrast, but it's equally significant, with Venezuela. President Maduro accusing the U.S. of destabilizing the Caribbean with a naval buildup, and then explicitly declaring his country has backing from China, Russia, and India. What's really fascinating here is how these statements from Xi, from Maduro, they just underscore this rapidly shifting global order, traditional alliances being reevaluated, new power dynamics emerging, creating a much more multipolar world. Countries are looking for support from a wider range of partners now. It's not just about shifting allegiances as part of that bigger trend towards maybe de-dollarization, a fragmentation of global governance, multiple power centers vying for influence. It's a very fluid landscape reshaping how the world works.
Wow, we have covered a huge amount of ground today, haven't we? From those subtle signals in currency and commodities navigating that economic uncertainty, to the intense geopolitical hotspots, Middle East, Ukraine, and then this strategic maneuvering for influence across Asia, Latin America. What seems really clear isn't just how interconnected it all is, but the patterns these events form. Shaping our present, definitely shaping our future. It's like watching this global tapestry being woven thread by thread in real time, each one influencing the next.
Indeed. Every market move, every diplomatic chat, every military action. It's a thread in that much larger tapestry. The challenge, I think, and really the opportunity for you listening, is to see beyond just the individual events, to see the deeper patterns, the underlying forces, which leads to maybe an important question for you to think about long after we finish here. How do these immediate market moves, these geopolitical shifts, how do they ripple out long term? How do they shape future international relations, future economic policies in ways we might not even fully grasp today? Think about those unforeseen consequences, those subtle shifts that could become tomorrow's really big trends.
That is a truly thought-provoking question to leave things on. Thank you so much for joining us on this deep dive today. We really hope you feel more informed, maybe a bit more connected to the global picture, and encouraged to keep exploring, keep connecting the dots yourself. Until next time.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.